If you're invested in the stock market, you need to know about taxes and how to invest so that the taxes are in your favor. This is part one in my series of stock market taxes for beginners explained. Now, quick disclaimer, I am not a tax professional. I am not an accountant. This is just based on my own personal research and experience. So please always do your own research and due diligence and don't just trust someone on social media. In this series, I'm going to teach you what to do with money that you make in the stock market, what to do with money that you lose in the stock market, your dividend income, your interest income, and how to reduce your tax burden in the stock market. So if that sounds good to you, follow along. Let's start with the basics. In the stock market, your taxes are calculated based on the calendar year. So from January 1st to December 31st. And your brokerage account is the one that will keep track of all of your activity in terms of gains, losses, interest, dividends, etc. Now, to make sure we don't miss any important tax deadlines and documents, we need to take a look at the calendar. So let's just say December 31st is over. It's now January 1st. Happy New Year. By February 15th, your brokerage company, whether that's Fidelity, Vanguard, Charles Schwab, etc., they are required to send you what is called a consolidated 1099 form. And this form is a form that you need in order to file your taxes for the previous year. And this form includes three different forms. It includes what's called a 1099B, which is going to have how much money you made or lost in the stock market last year, a 1099INT, which states how much interest you earned in your brokerage account for the past year, and a 1099 div or dividend, which will report the amount of dividends that you earned in your brokerage account for the past year. Now, you might be asking yourself, well, why can't my brokerage account just generate these documents on January 1st? Well, there's a reason for that, because there are certain types of transactions that you might make within your brokerage account that can retroactively affect your taxes. Let's say that 2025 has ended and it is January 15th of 2026. What you do in January 2026 can affect your taxes in the previous year. One example of this is what's known as a wash sale rule, and I'm not going to get into the specifics of that, but just know that that is the reason why brokerage companies cannot generate a consolidated 1099 on January 1st. Worst case scenario, you get your consolidated 1099 form mid-February, and that gives you plenty of time to finish filing your taxes by that April 15th deadline. Now let's go over some of the most common situations. So in the stock market, you will only pay taxes if you make money. If you lose money in the stock market, you will not pay taxes. In fact, if you lose money in the stock market, you will actually get a tax deduction. Let's look at an example of if you make money in the stock market. So let's say that you own one share of Apple stock and it costs $100 to buy. Now, let's say you sell that one share of Apple stock and you're selling it at $150. So congratulations, you have made $50, but you will not pay taxes on that full $150. You will only pay taxes on the $50 gain that you made. But how much will you actually pay in taxes on that $50? Well, it depends on what tax bracket you're in, which depends on how much money you make. But for simplicity's sake, let's just say you're in the 10% tax bracket. So you made $50 times 10%. You would pay $5 to the IRS and you would get to keep $45. Here's an important part you need to know in order to save yourself a lot of money in taxes. So in the stock market, if you hold a stock or hold a position less than 1 year, you will pay taxes on your gains at the regular tax rate if you made money on that investment. That is called short-term capital gains. Short-term, as defined in the stock market, is anything less than 1 year, 12 months. Back to our example, if we're in the 10% tax bracket and we made money in the stock market, and we will pay 10% in short-term capital gains taxes. Works the same way. If you're in the 35% tax bracket, you will pay 35% tax on your short-term capital gains. So on your positions that you sold, that you made money on, that you held for less than 1 year. On the flip side, if you hold the asset or hold the stock for more than 1 year, that is what's called long-term capital gains. So if you make money in the stock market on a stock that you have held for more than 1 year, you will pay long-term capital gains on those earnings. Long-term capital gains receive much better tax rates than short-term capital gains. And in this case, it doesn't matter what tax bracket you're in as far as your income. The current levels as of the date of this video, if you are in, let's say, the 37% tax bracket when it comes to your income, you will pay long-term capital gains taxes of 20%. If you are in the 25% tax bracket, you will pay long-term capital gains taxes of 15%. And in our example, if we were in the 10% tax bracket for income, our long-term capital gains taxes would actually be 0%. And if you don't believe me, just go Google it. This leads me into another important point that you need to know. You will only trigger a tax consequence, a taxable event in the stock market when you close your position, so when you sell. Let's go back to our Apple example. So if you bought Apple stock at $100 on, say, January 15th, 2025, and on December 31st, 2025, Apple stock is $150. As long as you don't sell that Apple stock, you will not trigger any tax liability. It will not be considered a taxable event because you did not close your position. You still own it. And let's take that out even further. So let's say it's 2026 now, and you are still holding on to that Apple stock, and that Apple stock is now $200 a share, but you're still holding it. You didn't sell it. That is still not a taxable event. There's no tax liability there yet because you didn't sell it. In that case, there's nothing to report on your tax return. Now, let's say it's 2027 and you're ready to get rid of your Apple stock. So let's say at that point, your Apple stock is worth $250. So you have gained $150 because you bought it for $100. It is now at $250. So your gain is $150. Your tax liability in that case then is the $150 that you gained on the stock. And you will have a much better tax rate on that because it's a long-term capital gains because you held the stock for more than a year. So that's all for part one. In part two, I'm gonna go over what happens as far as tax liability when you lose money in the stock market. If you found this helpful, share it with someone else who could benefit, follow along. I also have a free weekly newsletter where I go into all these topics in more depth. You know where to find it.